I've seen a number of estimates of the shortage of silver at the LBMA. One estimate said there's only 6 weeks supply ahead, and another one said there's 4 months, so that's quite a big difference. What's left is going to be very much spoken for in terms of it's leased out or it's held by an institution which has no plans to ever sell it at any price. So when you have a situation like that, if the demand continues to be higher than the supply coming in, and by the way, there has recently been a report, I haven't read into it, but a report of big shipments from America to London of silver. But if the supply is not coming in, you then get a kind of leveraged situation when people want silver, but it's in short supply because the leasing rates at one point I heard were up to 40% a year.
In today's news recap, silver retreats from record high on concerns of overheating. Silver retreated from a record high with a key technical indicator showing that a 6-day rally has taken the white metal into overbought territory. Gold also edged down. Silver traded at around $57.45 an ounce, more than $1 below the all-time peak reached in the previous session. Traders have been betting on continued supply tightness and expectations for another interest rate cut in the U.S., a tailwind for non-yielding precious metals. The 14-day relative strength index, however, shows that this recent speculative fervor may have gone too far too fast. A reading of above 70 shows that the momentum is overheated. We have now moved on beyond rational momentum. Daniel Ghali, senior commodity strategist at TD Securities, said in a note, "Demand expectations have declined across all categories, leaving investment demand as the primary driver today," he said, citing weak physical trading in London's over-the-counter market. The rally in silver, which rose more than 8% over the previous 2 sessions, has been fueled by bets on prolonged supply tightness. Since record amounts of the metal flowed into London to ease a historic squeeze in October, other trading hubs have come under pressure. Inventories linked to Shanghai Futures Exchange's warehouses recently hit their lowest in a decade. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
That video that you have to buy silver miners. But I have been looking in the last few days at a number of the silver miners and revaluing them. The ones I looked at, I consider still to be very undervalued at today's silver price. I would say they're probably pricing at a silver price of $25 at the moment, not $50, or now we're $57, aren't we? So if this price holds, and I think we'll have the up and down, but I think there's a floor in the range of 45 to 55 at the moment, and then we move up into the higher levels. But let's assume that range holds. Those silver miners are going to be on extremely or very low price earnings multiples next year, when we're talking about the 2026 profits, with probably a higher price than today's price. So in a doubling of the silver price from 25 to 50 doesn't mean to say the shares double. It means they do a lot more than doubling. So when I did my calculations on a number of silver miners, they all look like they got many multiples higher to go. And and you asked me to name some of them. Well, there's a lot I like. There's Majestic Silver, there's Pan American Silver, there's Silvercrest, Heckler. And by the way, I don't own many of these. I own 1 or 2 of them. Discovery Silver, Andean Precious Metals, which is gold and silver. Kingsgate Consolidated, gold and silver. Silver X is one of my favorites. It's a fairly new producer, but it's got a very, very leveraged upside. That's been one of the best performers, but I think it's going to be an absolutely phenomenal performer going forwards. And this is not investment advice. It's just my personal opinion. I've done my maths my way with my assumptions about what the silver price was. And when I did the maths, I assumed the silver price would be $50 in 2027. that's a rather conservative estimate. It could be a lot higher, but I used a $50 price and worked out what will the earnings of these companies be in 2027. And if the earnings are that, and I put a price earnings ratio, a modest price earnings ratio, by the way, I used 10 times on these companies, where do I think the share price will be? Then I compare that share price with what it is now, and there's many multiples upside. Another one which I particularly like is called Silver Corp. That's a particularly good one. But, you can't really go wrong if you buy the silver mining ETFs or the silver junior minings ETF. At this point, I'd probably go for the mainstream silver miners rather than the juniors, even though the juniors potentially have I'm going to say, like, lots of juniors have huge upside. The problem is lots do not, because they're going to run out of cash. So if you're buying individual companies, and this is what I would recommend to anyone who's trying to buy silver miners, unless they really, really know what they're doing, and I would say I know enough about juniors, but unless you really know what you're doing, you should stick with the majors and the ones which are either already producing or just starting to produce. Then you know what's coming out of the ground. You can do some maths on that. You can look at how many ounces they're producing, and they say they'll produce. You can look at what the silver price is, what you think they'll get, and that's your number. You can put $50, $70, $20, whatever you like. And then you look at the cost per ounce coming out of the ground. And now you have a gross profit before other expenses. The other expenses are easy to see on the website, just deduct them. And you now have net earnings, divide that by the number of shares, and you've got an earnings per share. Multiply that earnings per share by the multiple that you want. I use 10 times, but lots of people might use 15 or 20 times. And you get to a future share price. If you can't do it yourself, get AI to do it for you. There's some very good AIs out there. Perplexity will do it. Grok will do it. Manus AI will do it. I'm guessing that ChatGPT will have a very good go at it, but ChatGPT, I'm finding, is sometimes a bit lazy and only does half the job, so I'm not really happy with it at the moment.
In today's news recap, cash is cringe, how Gen Z is redefining saving and spending. Gen Z may be the most financially self-aware generation yet, but new data from the Harris poll for Cash App shows that access and awareness gaps are slowing their progress. While 90% of Gen Z workers are learning new financial skills and building savings habits, nearly half do not know whether their savings accounts earn interest or if they could be earning more. The findings come as Cash App introduces a 3.5% APY savings rate for its teen customers ages 13 to 17, addressing the clear need for accessible, high-yield tools that help younger savers grow their money and build financial confidence early. Gen Z wants to save but isn't sure how to grow their money. According to the study, 77% of Gen Z say they would contribute more money to savings if they could earn interest. Yet awareness is limited. 44% of Gen Z with savings accounts know their current interest rate, 32% do not, and 16% are unsure if their accounts earn interest at all. Nearly half have less than $500 saved. What do you think, you guys, is cash cringe, or are just they broke? The data underscores how financial literacy and product transparency are shaping Gen Z's early financial journey. Their goals are practical and forward-looking, saving for emergencies, major life milestones like moving out or college, and experiences such as travel and events. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
I think this is late beginning. In terms of what's driving it, well, we've got a lot of things driving it at the moment. Some of them have been around for a few years, and some of them are relatively new. We've got the fiscal deficits in the United States. So let's face it, what happens in the United States is very important to the value of gold and silver, because the less confidence people have in the US dollar, the more they're going to look for alternatives. And at the moment, there doesn't seem to be enough actions to address those deficits, which are set to be the largest ever on record this year. This year started in October. That's the fiscal year for the United States. So it's going to be at least 2 trillion of deficit, the highest ever. We've got lower rates coming from the Federal Reserve, or at least that's the opinion at the moment. Now that can change, because I know it's not 100% certain they'll lower rates in December. But the opinion at the moment is we still got lower rates coming. Then we've got central bank buying at record levels for the last 3 years. So central banks have shown over the last 3 years buying 1,000 tons of gold a year on average over the last 3 years. They've basically shown that they don't care about what the price is. They just want more gold. And there's a good reason to want more gold. And that is, we've seen a certain weaponization of the dollar. And it doesn't really matter whether you're friends or enemies with the United States. You've got to think, what if I suddenly can't get my hands on, or I can't deploy my dollars for some reason? You know, there's been a lot of surprises in the last 11 months. If you know what I mean, surprises that people never saw coming, and a lot of seesaw, whipsawing back, they call it the taco thing, the taco trade. Trump always chickens out, but it's not really that. But the point is, you don't know where you stand from one day to the next. One day you've got a tariff, next day you don't, then you do, and then there's a retaliation from another country. So things are a bit chaotic when it comes to investing, and particularly relying on the dollar. So I think people are looking for something which can't be restricted, can't go to zero. So in that respect, gold is coming in. So then we've got the geopolitical events going on. That's not new. Geopolitical events have always been there, but obviously people think that there's a heightened tension at the moment. And that, again, is a reason why people would want to lay their hands on gold. When I say people, I'm talking about countries. And a lot of the buying has been coming from third world countries, like China, Kazakhstan, Poland, those sort of things. I don't mean to be derogatory to call them third world countries. They call them, not the Western countries, shall we say. That's kind of what I meant. That's kind of where the buying is coming from, countries which are maybe not, as of today, the greatest friends of the United States. They're not enemies either particularly, but, they're just, well, maybe some of them are, but they're just sort of saying, let's get some just in case. But I think there's also something going to continue to drive it in the next few years, probably out to 2027, 28, 29. And that's the coming digitization of currencies. We've got, starting next year, the rollout, to start with, of the digital euro, and that will go fully live the year after that. Now, I don't want to go into too many details because it's a very, very long topic, but the long and short of it is, I think you better get your gold before you've got the digital euro arrives. I think that's my, if anyone wants to know why, look at my last video, but really get your get your real gold before the digital euro arrives, because you will perhaps find that you will no longer be able to deploy your assets in the way you want, your money in the bank in the way you want to. It obviously was rather convenient that things broke down just at the high point, just as it was hitting a peak. And in a way, one could say that maybe gave the shorts some kind of breathing space to figure out what they're going to do without getting margin calls while the silver price was hitting all-time highs. So they can't send out a margin call in the middle of the day, or think about a margin call if there's no price to make a margin call. But what we did see, which was quite interesting, during the period when the shorts could no longer roll over their shorts or do whatever, or initiate new shorts, the spot price rose sharply. I think it went up by 5.7% on the day. So in one sense, that kind of shows us what the real supply and demand might be if it weren't for what everyone suspects is market manipulation. And I want to stress, I'm not part of the conspiracy group. I don't really believe that there's market manipulation going on. But I have to accept that it is a possibility. But I think this overheating was just convenient and not necessarily sinister. But what causes overheating? Why that day and why not any other day? I don't know. There's got to be a nagging suspicion. But I'll put it down to randomness.
What do you think of today's show? Do you believe that the current gold and silver sell-off is some sort of coordinated attack against the metals, or on the contrary, is just big players taking profits after an abnormal rally? Post in the comment section your plan for gold and silver, and share with the stackers if you are taking any profits after the mega rally we experienced this year so far. Now, peep this video right here because it's a perfect fit for you, and I'll see you on the other side.